We have seen that understanding property investment is all about having an understanding of the future. But we've also realised that forecasting is no easy feat, especially when we don't have a clear understanding of the causes of what is shaping our financial, economic and social world. This presentation is going to look at the trends and especially explore the causes of economic and social trends that have affected Australia over the last generation or so. And we're going to be looking especially at the residential property market, although we could be extending our investigation into other property markets, since these tend to follow the same basic dynamics, although for slightly different reasons. In economics, it is said that all economic activity is ultimately directed towards the consumer. And this means that the consumer, and that is really the household, is the final object of all economic activity. When we look at the patterns of household consumption, we see a rather curious thing over the last century or so. In this graph, what we see is the way that real household consumption was relatively stable for about the first half of the 20th century, up until about the end of the Second World War in 1945. Then we noticed that the trend changed, and since about that time it has been constantly growing year by year. Now this is impressive. However, we need to ask ourselves what the cause was, because if we don't understand the cause, we won't understand when the next shoulder, the next bend is going to happen. Because if we were doing property forecasting in 1930 or 35 or 40, we would have had no idea that from about 1945, 1950-ish, suddenly there was going to be a change that was going to go for at least a couple of generations, and who knows, might even go forever. However, the important thing is that the property forecaster, the economic forecaster, any time in the first half of the 20th century, most probably would not have had any inkling that there was going to be this fundamental change. Now, the important thing that we want to look at is what caused this fundamental change. Certainly there were some pretty major changes at that time. We had a major global war that came to an end in 1945. But a war alone is not sufficient to make this massive change. There must have been something happening back home. It may have had something to do with the increased technology that was unleashed as a result of the intense intellectual effort that was really a part of the fight of the Second World War. Before the Second World War, many people were going to work on bicycles and a lot of goods and services were delivered by horse and cart. At the end of the Second World War, there was a tremendous increase in motor transport and also the use of power machinery in industry as well. And so we can see technology definitely had a boost. But even this isn't sufficient, because we could say that technology had been increasing for, well, centuries, but especially from the mid-19th century when steam power was starting to be used quite extensively. And at the beginning of the 20th century, we started using air transport and so on. So there was constant technological improvement, even though we did have a major boost in 1945. We can ask ourselves many questions about what happened in 1945, but the important thing is that it points out the way that often, or at least sometimes, there are these major structural changes. Now we need to look at the pattern after 1945 for a little while. What is supporting the constant increase in real household consumption? And can that constant increase continue? This is an important question, because if we assume that we're going to be using data, say 20, 30, 40, even 60 or 70 years old now, it will all be following that pattern, the post-1945 pattern. What would happen if there was reasons for that increased real household consumption pattern that were in fact expiring and maybe being replaced by other factors? Is there going to be another fundamental shift in this pattern of real household consumption growth? We need to look at this question rather carefully. Our real object here, in looking at the trends, is to see where the next bend is going to be, and not just in household consumption patterns, but also in property directions and so on as well. A very different trend was examined by Abelson and Chung from Macquarie University, who looked at economic data from about the 1980s onwards and noticed a curious thing about house prices. Abelson and Chung reasoned that from one generation to the next, it's necessary for house prices to maintain some kind of a parity to adult wages. If they don't, it means that the proportion of an adult wage which is turned towards housing, if that is increasing, it means that there's a lower percentage of that adult wage, that income, that's available for other consumption. And so if housing is allowed to go too high, it means that the standard of living, which is expressed by that person's ability to be able to spend the rest of their income on other things like food and clothing and entertainment and so on, tends to be diminished. We see this today as the affordability question. When Abelson and Chung were looking at it, now some years ago, they were concerned that there did appear to be a problem with intergenerational equity, because what they could see was that the cost of housing was increasing considerably faster than adult wages. Their approach was significant departure from what most economists and property people were looking at, which was the way that house prices tend to grow faster than inflation. It's a nice feeling to see house prices moving ahead, especially if you own one or aspire to owning one. However, if you're a tenant, or looking at the number of years of saving that is required to move into a house is increasing faster than you can save, it's not such an attractive proposition. This notion of intergenerational equity is rather curious. By focusing on it, it really focuses on an aspect of our culture that most of us don't look very closely at. And that is that if we move into a house, even to occupy it ourselves, but with the expectation of a capital gain, it means that when we finish with that house and sell it, which is really selling it to the next generation, that next generation will be burdened with a greater relative debt, at least relative to their income, than we did when we bought into the house. And it means that as one generation passes housing on to the next, the future generations are actually burdened. They're relatively at a disadvantage. The older generations are exploiting in some subtle way the future generations. Now, this is not an explicit or a purposeful thing. It's just one of the artifacts that comes from the way that we do real estate. However, there must be a limit to how far it can go, because quite simply, it does mean that these future generations are going to be faced with a continuously diminishing standard of living, unless they work harder, longer, smarter, or what have you. But then the question comes, if they do work harder, longer, and smarter, isn't it their right to take the income from that harder, smarter, longer work that they're willing to do, rather than simply surrender it as the purchase price to the exiting generation? These are questions that go outside of the strictly economic parameter, but they are certainly issues that are very important for the community, and the community relies on property economists to be able to have an informed and sensitive view to these issues that really do have the potential to shape our future society. To develop an understanding, or at least a sensitivity to these issues, we need to step a little bit outside of our normal cultural parameters, and certainly the parameters that normally circumscribe property economics. And to do that, we're first of all going to consider a conceptual analogy, because the argument will be developed that in some ways the last generation or two have acted a bit like a farmer. Let's look at a farmer here who has a herd of 1,000 cows, and let's say that each year the herd produces 200 cows. And the farmer knows that he can sell those 200 cows each year, and that becomes his revenue. And by doing that, he has that revenue of 200 cows and a stable capital base. This is expressed in this diagram that shows the cause, which is the capital base, the herd, the 1,000 cows that the farmer has, and the effect, which is the net income that comes from caring from those 1,000 cows, which is his net income of the 1,000 calves that he's able to produce and then sell for income. But let's now imagine that our farmer wants more income. And he reasons that rather than selling 200 cows, he can sell 300 cows per year without making a huge difference to his herd. And in fact, perhaps he's optimistic that for some reason his herd might become more fertile in the future and replace the extra 100 cows that he's taking at present. Perhaps he's been convinced by some agricultural consultant to increase the productivity of his herd by using some new management practice or maybe some new drug. So our farmer starts selling the 300 cows per year. That means his net income, which is equal to the revenue from 300 cows, actually represents a 50% increase. And so our farmer, of course, is very happy. However, when we look at the diagram of cause and effect, and we realise that the supposed increased fecundity of his herd hasn't been realised, even though he was confident that it would, what we're seeing is that the effect, the income, has increased by 50%. And that's fine. The farmer becomes quite comfortable with that, expects it to continue on to the future. However, he's turned a blind eye, for whatever reason, to the fact that little by little his herd is being diminished. And we can see that in his capital stock on the top trace. Now obviously that's only going to be able to continue for so long. Let's imagine the herd diminishes down to the point where he only has 500 cows. At this point he's only annually producing 100 calves, and the farmer may realise that he must only sell a sustainable fraction of his herd if he's going to have any capital left in the long term. So now he pulls his belt in and only sells 100 calves per year, which means that his income has come down by 66%. He's gone from 300 cows per year income to 100. Obviously the farmer is not happy. The most unfortunate aspect of this is that the new situation is going to be his permanent income. And we can see this in the diagram. When we look at this diagram, while it's obvious as we tell the story, as the farmer is going through this change, it may not be quite so apparent. But I'd like to point out the way that there are a number of shoulder points, a number of changes in this diagram. At the point where the farmer starts selling the 300 cows, we notice the income increases significantly. This is one change. But note that that becomes a constant situation for some time. So long, in fact, that if someone was doing a forecasting exercise maybe close to when the farmer discovers a bit of reality, you might look back on a few years of production from the farm, or at least sales from the farm, and notice that the farmer had been selling his 300 cows. And so he'd be likely to perhaps forecast 300 cows being produced by the farm off indefinitely into the future. But of course there are a number of other shoulder points here, changes. Now we can see that each one of these changes has a cause, even though in themselves they may not have been so obvious before they became apparent, before they became real. The task for us is to see if we can understand the signs in our culture that have been responsible for the shoulder points, the changes in direction of various economic and social trends, and be able to develop a sensitivity to seeing what they might imply for the future and what other changes may impact on the community which will be significant for property into the future. The expression selling the farm refers to this kind of behaviour, selling the capital, usually with some kind of optimism of the long-term future that unfortunately is unrealistic, or it proves to be unrealistic in the fullness of time. While individuals can be guilty of selling the farm, so can communities, and in fact entire nations. Obviously, if that change in real household consumption was the result of selling the farm, we would be passing on to the next generation a rather unhappy future. But there may be other ways in which we have been using real estate, which effectively does the same thing. And we're going to be exploring some trends and looking at their causes to see where we may have been selling the farm and why this might be leading to changes into the future. Selling the farm happens whenever we fail to maintain capital. However, it's important that we have a far broader understanding of capital than simply what we find on the balance sheet. Capital can include both material and economic capital, but also social and human capital, and it can include intellectual capital. In fact, anything that humans use in order to produce those things which are needed to maintain the community is in some way a form of capital. One thing that happens when you sell the farm is that you always end up with short-term gain, but long-term and permanent loss. One way or another, selling the farm is always associated with capital decay, although we need to see this broader than simply economic capital decay, but look in terms of more generally social and cultural capital as well. If we look at some of the social changes that came into Western society over the last half century, we find that they have been far more significant than possibly any single similar period back at least for 500 years. The most important social change that had an economic impact was the formation of dual income households. Around 1970, the average household had a single income, but today it's highly unlikely to find a single income household. Linked with this is lower household occupancy, which means smaller number of people per household. There has been a fairly significant destabilisation of the family. And there has been generally a great increase in a sense of personal independence. However, all of these have defined the trends in property and financial expectations of the last couple of generations. And what we need to do is look at how it did impact on the past, but also look at what the impacts are likely to be into the future. Before we dwell too much on the causes, however, I'd like to focus a little bit on some of the effects and certainly some of the mysterious economic phenomena of the last generation or two. The first is interest rates. If we look at a graph of interest rates over the last century or so, we find that there was a very peculiar mountain of high interest rates dominating the period between about 1970 and about 1990. Now, to understand interest rates, we need to take a step back from them to really reflect on exactly what they mean for the community. While we're familiar with hearing the Reserve Bank threaten to raise and lower interest rates almost daily at present, let's just look back and think about what interest rate actually means to the community. By and large, the majority of working people in the community, which is the great majority of the community, will see their major relationship with interest rates as their home mortgage. And on this basis, the interest rate is a cost. It's a burden on the household, and it really defines the major aspect of housing costs for most people. And what that means is that it competes with other spending. If interest rates go up, for the average household, that means that their home mortgage payments go up, which means the amount that they have available to spend on food and sending the kids to school or going on holidays or whatever is reduced. And so interest rates become a very easy way of limiting the amount of spending power that the average household has. Generally, we can say that interest rates represent a social burden, and the higher they are, the more burdened society is generally. For this reason, as rates increase, it tends to affect the existing loans considerably more than the new loans. even though when the Reserve Bank raises interest rates as an attempt to maybe dampen the property industry, while it certainly may discourage people from taking out new loans, it can have very little effect on those many other people, maybe the 95 or 98% of the population who don't happen to be selling their house at a particular time or buying one, who do happen to have a mortgage and do find that as a result their standard of living goes down. As interest rates rise, their aim is to discourage borrowing, and this certainly is true. However, we have to look at the way that high interest rates generally just simply represent a cost, a drain of economic vitality out of the general community. With this as a background, we can look at the pattern of interest rates over the last century and ask ourselves, how was it that the community was able to afford these very high interest rates for the best part of 20 years? If we look at this graph quantitatively, we can compare it to our current rates, which are pretty close to the threshold line which is drawn across the graph to distinguish low rates from high rates. Currently, interest rates around 7 or 8% are fairly modest. But however, when we look at them in terms of long-term history, what we find is that our 7 or 8% interest rates for home mortgages, which we now take as normal, are in fact historically high compared to most of the 20th century. And in fact, if we go back even before the beginning of the 20th century, we find that interest rates were seldom above 6% at any time before about 1970. That goes right back to the very beginning of the colony. And so our current regime of 7 or 8%, perhaps even more, is in fact historically high. By contrast, if we speak to most people about interest rates today, people will tell you horror stories about when they were paying 15 or 18 or maybe even 20% in some cases for money for home purchase. This is because the older generation has very vivid memories of when they were borrowing through the 80s and 90s when interest rates were up around those levels. If we look around our community today and say, how would our economy behave if interest rates went up to 12 or 14%? However, it wasn't so terribly long ago historically that our economy was actually thriving at exactly those interest rate levels. But it was only able to do it for this odd 20-year period because it couldn't afford to be burdened by that level of interest rates at any time in the past, and most probably, I suspect, at any time into the future. Our question is, what was the cause of the community's ability to withstand those very high interest rates? We now want to turn our attention to the history of inflation. Here we see a graph of inflation over the last century or so. And what we see is that while the inflation trace was up and down all over the place through the last century, when we look at high levels inflation, that is inflation above about 6%, or the line which has been added to the graph, what we see is that the periods of high inflation were relatively short-lived. On the couple of occasions during the first half of the 20th century when they occurred. The other thing that stands out about them is that by and large they were associated with the two world wars. The First World War had inflationary and then deflationary effects around the beginning and then the end of the war. The Reconstruction after the end of the Second World War had a sustained period of economic boom, which also became inflationary. But that was on the back of price constraint through the war, which artificially discouraged a natural level of inflation, shall we say, of 2 or 3%. And so the periods of high inflation in the first part of the 20th century can be explained in terms of the social dislocation that the war, or the two world wars, represented. However, we move along further and we see that there was this very long period of sustained high inflation from about 1970 to about 1990. And we can look at that and say, well, what does that mean? The first thing that we need to be wary of is that inflation acts like a cost and a tax. For anyone with money in the bank, inflation acts like moths on your clothes. It depreciates the value of your saving. For households relying on wages, so long as wages trail behind increases in prices, inflation serves as a drain on the household resources, the household ability to support a standard of living. So high inflation usually represents depressed standards of living. In macroeconomics, inflation is considered to be a tax. This is a little complex to explain, but simply it means that the originator of the new money, which is usually the government and sometimes the banking system, tends to benefit by being able to spend the new money, the inflated currency, at face value before it starts to move through the economy, generally changing prices and causing everyone else who uses that same money to have less spending ability. And so generally we can see that inflation acts as a drain, a bleed, a limit on a household standard of living, their ability to provide food, clothing and shelter, the standard of living that the household seeks through their work. Economists will tell us that inflation is caused by excessive spending. The only way we can get excessive spending is to also have excessive borrowing. When we look closely at this period, we find that there wasn't too much excessive borrowing, but it certainly was a period when the economy was quite buoyant. Where did we get the money to spend, and how did we afford it? Especially, how was it that it was able to happen at the same time that interest rates were elevated? The reason this is significant is because conventional economic theory believes that interest rates always work in the opposite direction to inflation. That is, if interest rates go up, inflation will go down, and vice versa. To have both high interest rates and high inflation and an economy sailing along is a very peculiar thing. And yet one way or another, our culture was able to support record high inflation at exactly the same time as we had record high interest. That confused the economists at the time, especially when there was a brief period in 1974 of economic stagnation. By and large, economists couldn't understand how you could have inflation and economic stagnation at the same time. They were theoretically not supposed to happen simultaneously. However, they did. The economists called it stagflation and have never quite been able to get their head around what exactly caused it. But likewise, this problem with interest rates and inflation. Today we're familiar with the idea of the Reserve Bank telling us that inflation is getting a bit high, therefore we'll stop it by running up interest rates a little. And we seem to believe that if interest rates go up by 1/4 or 0.5%, that will certainly knock inflation on the head and will be gone. However, it didn't seem to work during this period. How was it that the economy, the community, was able to subsist for 20 years, that's almost an entire generation, with the double economic burden of high interest rates and high inflation? We have to look outside economics to find an answer to this puzzle. But the answer is found in the trends in female labour force participation during that period. This chart shows female labour force participation for selected ages, roughly between 30 and 45. These are the ages where most families, most couples, are considering having children, and certainly having a mother at home caring for their kids. And so we're looking at the change in labour force participation rates over the last century for these critical family ages. What we find is that for these age groups, which is the economic dynamo of the community, they had increased labour force participation, which means that households were developing double incomes, which necessarily increased their purchasing power. This enabled the households to be able to spend more because of their higher levels of disposable income, therefore causing the inflation without borrowing, which puzzled us in the previous slide. Also, when they had their heart set on buying real estate, they were not discouraged by higher interest rates because they had the extra income to be able to pay them. Especially in an inflationary environment where one of the major components of inflation was house price inflation. Households were seeing that it was particularly desirable to buy houses, even though the prices were rising and even though interest rates were very, very high. Because once you bought in, the capital gain made the pain of the extra interest rates worthwhile. And this is what people were doing through the 70s and 80s. And they were largely funding it through the second income that they are able to marshal for their households. During this period, the whole profile of the labour force was changing. And we see this in this slide, which looks at the trends in labour force participation for both males and females. This chart just happens to catch the tail end of the rapid rise in female labour force participation. But notice as well that male labour force participation has been falling over that entire period. And so even though for many households they were enjoying a double income, overall the level of labour force participation was actually falling, at least for the men. Totally, it has been rising though, and this is the middle line that we can see between the two, which represents the total labour force participation. However, the sobering part of this chart is the right-hand side, where we can see that little by little, labour force participation has actually passed its peak. And in passing its peak, it means that households have passed their peak income ability as well. While the history of labour force participation profiles has been a generation of growth and the ability to support constant rises in household income and house prices, and overall a booming and flourishing economy, because the labour force participation future tends to be somewhat more restrained, especially as a result of the ageing population, the profile of boom and plenty that characterised the last 40 years may actually be reflected in the negative in the next 40 years, especially as ageing due to insufficient previous investment in the future generation, which is the other aspect of increased female labour force participation, is going to have an impact on our society into the future. We call that reduction in future workforce the ageing population. We can see this explicitly in the trends in Australian birth rates. The chart here traces the Australian total fertility rate, which is the blue trace, and you can see it has been falling from the late 1800s, more or less down to somewhere relatively close to today. When we look more closely at this trend, we do find that there are a number of particular events and landmarks that are on it. In particular, we notice that while the fertility rate was falling from the late 1800s to about 1930, it did recover from about 1930 to a peak in the early 1960s. Today, people who were born as a part of that peak are referred to as baby boomers. And while it's often explained as the reconstruction that happened as a result of the end of the Second World War, when servicemen came home, started the families that had been postponed while they were away being soldiers, In fact, the baby boom generation reflects a fertility level which is really only a return to the fertility level of the early 20th century, around the 1910-1920 fertility rates. It wasn't in fact a record at all. But since that peak in the early 1960s, the fertility rate again has plummeted. In particular, we notice that it plummeted to a rate below about 2 babies per woman. The scale that we use here, total fertility rate, relates to the number of children that a woman is likely to have during her entire lifetime. It's generally considered that for a community to replace itself robustly over time, a total fertility rate of about 2.1 is necessary to maintain a stable population. That's because some children don't end up getting to an age where they are able to have families of their own, and so we need a little bit more than the bare 2.0. We see that we fell below the 2.1 back in the early 1970s. However, we can also notice that the fall in fertility has largely been arrested since about 1975. Somewhere around the 1.7, 1.8 mark seems to be the stable norm for Australia at present. Other countries, say the United States, is maintaining very close to the 2.1 of zero population growth, whereas many parts of Europe have total fertility rates well below 2, down around the 1.4, 1.6 mark. So Australia is fairly centrally placed in terms of developed countries. However, the reality is that with a fertility rate below 2.1, without immigration, Australia's population in the long term must start to fall. A separate social trend which has also affected the last couple of generations is the increase in family breakdown. And we can see this in the divorce statistics over the last century or so. Up until 1975, divorce was relatively rare in Australia. This is because the legal hurdles related to getting a divorce were fairly difficult until the passing of the Family Law Act in 1975. We can see this in the graph where divorce suddenly shot up, and there seems to be a certain amount of pent-up demand in the late 70s. However, the divorce rates in Australia have settled down to what is still a fairly elevated rate. The significance of a high level of family breakdown is interesting and complex for property. On one hand, it means that as families break up, it necessarily leads to smaller households, and therefore a greater number of dwelling units that are required to house the same number of population. On the other hand, divorce tends to result in a significant reduction in income and wealth for the splintered family, and as a result of that, their capacity to support household costs are reduced. Overall, the long-term impacts of increased female labour force participation by putting off having children and the reduced overall Australian fertility, resulting in lower family size, has resulted in falling household size. We can see that household occupancy, which is the number of persons per occupied dwelling, was relatively stable in Australia for the first part of the 20th century, up until the mid-1930s. But from about that time onwards, household occupancy has been trending down. We've got now to the point where from about 1970, we were at 3 people per occupied dwelling. Now it has fallen fairly rapidly through the 70s and 80s to about 2.5, 2.6. However, again, we can notice that while there was a sharp fall from about the 1930s to about the 1970s or 80s, there does seem to be a shoulder. There has been a change in the rate of reduction in household size. Now, there are some biological necessities that need to be recognised that will maintain a floor on household size. If households fall below about 2.5 people, it means that households no longer have the capacity to have children. This is already happening in some inner city suburbs in capital cities, where household occupancy rates for entire suburbs average less than 2, and in some cases less than 1.8. This means that for these suburbs, to go home and have somebody to talk to means that you are living in a household of above average size. Obviously, it's very difficult for mum and dad and a child to live in that kind of an environment. This would suggest that household sizes of below 2.5 or 3 are really non-sustainable for the long term. The advantage of a small household size is that if the household consists of 2 employed adults, the household is composed of 2 incomes with only 2 dependents, and so it has a very low dependency ratio. This can be contrasted to a household, say, in the 1920s or the 1930s, where there were considerably more people in the average house, and typically there'd be only 1 income. If we have a household size of 4 or 5 people, let's say 5 people, and that is being supported by a single income, obviously that income has a lot more work to do. It has to be spread a lot thinner than the current situation where you have 2 incomes being distributed amongst only 2 people. Now we can return to our graph of household consumption and start to look at maybe some of the causes. We did note at the beginning that 1945 was the turning point where all of a sudden household consumption rates started to improve. We can conclude that the first part of that increased household consumption was on the back of the technological improvements and also the post-war reconstruction and the economic stimulus simply due to the amount of house formation and family formation that was happening at that time. And these combined to provide quite solid economic multiplier effects that ran through the economy for several years. However, this in itself isn't sufficient to maintain this trend indefinitely, because once that increase in technology has settled down and become the norm, the household consumption pattern should go back to a stable pattern over time. And the same with the stimulus from the sudden increase in the number of houses being built and families being formed. Once that level of household formation stabilised, the patterns of household consumption also should have stabilised. What we find is that the increase in household consumption was really supported from certainly the mid-60s onwards as a result of the reduced fertility and increased female labour force participation that we saw in the data from about that period. And so while 1945, maybe through the 1950s, was able to support increased standards of living and household consumption, that tended to give way to the stimulus that was caused by the female labour force participation and reductions in fertility during the period 1970 to about 1990. So far, we've explained the direction of this graph from the end of the Second World War up to about the period around the 1990s. However, what happened from 1990 to the present? What's the cause? To approach this question, we need to look a little bit more closely at the available data. First of all, we came in looking at Abelson and Chung's concern about intergenerational equity. On this chart, we look at the dynamics of intergenerational equity and the changes in the household that were happening between about 1970 to 1990. While Abelson and Chung were concerned about intergenerational equity based on adult wages, what we see in the data is that house prices track household incomes up to the late 1980s. What this means is that once house prices stopped following the change in wages and moved to household incomes, what was actually happening there was that the increased economic vitality that came to the household as a result of the second income was actually being siphoned off by house prices. And so house prices actually had the capacity to take the extra income, the extra spending power, potential standard of living or what have you, from households that had decided to opt for the second income. And as a result of that, the intergenerational aspect was that whereas a single income family could support itself in 1970, by the time we get to the late 1980s, to have the same standard of living, they simply needed two incomes. I may not be telling you anything new. However, you'll notice that from that period, the late 1980s, house prices have tended to leave behind even household incomes. And so there has been this gap between household income, which requires the double income to support the household, and house prices. Some of the explanations or some of the causes that are put forward to explain this are the increases in prices in general, which can be compared or measured by looking at the CPI, and we see that house prices and wages both exceeded the CPI, so that's not an influence. Also, some commentators say that the increased building costs are the result or have resulted in the increase in the house prices. Sydney's building price index has been plotted in the blue line, and we see that while this is modestly above the CPI, building costs have actually increased at a lower rate than adult wages. And so house prices, if they only followed the cost of building, should have actually become more affordable rather than less affordable over the same period. Before we leave this slide, it's worthwhile looking at the household consumption graph as well as the household income trace. You'll notice that household consumption for the major part of the period between about 1990 or the early 1990s and about 2005, households were consuming at a higher level than their income would suggest they were capable of. This is a little bit mysterious, and we'll look at this further in the next couple of slides. The March 2003 newsletter of the Reserve Bank of Australia carried an article which drew attention to the rising levels of household debts, and it presented the graph that is shown here. Generally, it was considered that when looking at other countries, when household debt to income ratios rose to around 140 to 160% of household incomes, generally the economies that had those levels of household debts went into stagnation and recession. This happened in both Germany and Japan. And the Reserve Bank of Australia was noticing that household debt levels in Australia were already above the 120% level. Now, in one sense, the ratio of household debt to household income is not that critical. The 100% is not some magic number, because households take debt over a long period of time, principally made up of housing debt, which is repayable over a 25-year period. And so it's not as though the bank is going to expect that you're going to be spending all of your income for the next year paying off your 110% or what have you of household debt. However, it's an indicator of how well placed households are in being able to pay for their debt servicing costs that we've dealt with in earlier classes. Now, generally, historically, commentators commenting on this increase in household indebtedness pointed to the fact that in the early 1990s, interest rates fell. They fell from what had been their generational highs of over 10% to our current regime of about 6 to 8%. And on the back of that sudden fall in interest rates, generally the community became far more positively disposed to borrowing. In addition, the community had seen over the last 20 years or so the tendency for real estate to appreciate in value very strongly. And so when the community was faced with the prospects of being able to borrow cheaply with low interest rates, and this belief that property experienced strong capital gain, the community jumped into borrowing, especially for housing. And we can see this in the Reserve Bank's graph, where the overwhelming majority of household debt is represented by owner-occupied housing. But also notice the extra slice of investor housing that was relatively minor in 1990, but a very significant percentage of household debt by the time you get to 2002. This is because the lessons that have been learnt through the 1970s and 1980s, which largely included the notion that the more you borrowed, the more you made, especially if you invested in real estate and were able to benefit from a negative gearing strategy, was able to make any person wealthy who had the capacity to be able to borrow. And once interest rates fell, many people had that increased borrowing capacity, and so they rushed out and all wanted to become property investors. The psychological drivers that were behind this move towards an openness towards larger indebtedness can be seen in this chart, which looks at debt servicing obligations. The blue line represents the total debt service obligations of households. The red represents purely the real estate component of it. And you'll see that towards the end of the 1980s, there was a peak in debt servicing obligations as a result of the extremely high interest rates, even though levels of household debt were relatively modest. As the debt servicing obligations fell due to the falling interest rates, that was the stimulus for many households to go further into debt because they suddenly found themselves, say in the early 1990s, with a significantly lower interest bill than they had had in the past. And so merely bringing their interest obligations, their debt service obligations up to something similar what it had been relatively maybe a decade ago, meant that they were able to borrow a considerably larger sum of money. That trend began, but then sort of took off in its own trajectory. And so we see that by the time we get to the mid-2000s, about 2004, 2005, debt servicing obligations had once again reached record highs. But the difference in the record high levels of debt servicing obligation in 2005 and where it had been in 1989 was that in 1989 it was largely the result of extremely high interest rates on a relatively low level of indebtedness. Whereas in 2005, it was the opposite. It was a relatively low level of interest rate on a very high level of indebtedness. Obviously, it's significantly more difficult to free yourself of a large amount of debt, such as people were experiencing in 2005, than back in the events of the late 80s and early 90s. And so the strategic position of borrowers is significantly different in the current regime. If we look at the levels of household debt over the longer period, we see that we can identify a couple of turning points. What we can see in this chart is that the level of indebtedness of households was relatively constant up to about 1990 or the early 90s, somewhere around 1992, 93, levels of debt started to rise significantly. And the level of household debt shot up from about 40 to 45% of household income up to peak at around 160%, around the same time as Australia was entering the GFC. You'll notice there's another shoulder point. From about 2006 onwards, Australian household debt ratios have remained relatively stagnant. Now this is significant. The increase in indebtedness over this period explains the way that consumption was able to run quite considerably beyond the level of income increases. And also during this period, it was pushing up property prices because a major part of the new debt was pushed towards both owner-occupied housing and also investment housing. However, like any situation of selling the farm, eventually that running up of higher debts means that eventually the amount of household income that's available for personal consumption spending will have to be reduced unless the investments are successful. In this case, because so much of the investments by most households have been in terms of speculative housing investments, it's unlikely that the community has as much capacity to support increased house prices and house rents into the future. To understand this, we have to look at the budget or the domestic economy of the household. Investment housing relies on increases in rent. Increases in rent rely on the capacity of tenants to be able to pay an increasing proportion of their household income as rent if rents are to increase at a faster rate than household income. But this is exactly what investors have betted on in taking on investments, especially on yields that are significantly below interest rates. If we have got to a point where Australian households have already tied up the extra economic benefit from their second income in their house servicing costs, and especially when it's not simply that extra income, but also the smaller household size, what we can say is that if rents are going to increase in the similar way to what they have in the past, it must be as a result of a reduction in standards of living, because it's only by reducing the amount of household income which is available for other spending, which is the food and clothing and entertainment and the other standard of living attributes, that rents will be able to be supported. And so this means that the Australian property market is at a curious position. If it is going to come back to being able to support the levels of growth that we've seen in the past, it can only do it by actually reducing the standard of living for that part of the community, which is either renting houses or paying them off. And considering that most Australians are in one of those two categories, that doesn't look good for the community in general. What this means is that unless we're able to have that falling standard of living, it's going to be very, very difficult for the current regime of house prices, which is what most housing investment is predicated upon, to be successful. To some extent, this mechanism is already being recognised in the community under the general title of housing affordability. What is being recognised in the housing affordability debate is that housing costs have risen so high that they are no longer affordable. And the only way to afford a house is to suffer a lower standard of living. However, the affordability measures tend to miss out one rather important characteristic of the changes that have happened over this period. Many of the graphs of housing affordability that have been presented in recent times look at the way that relative to household incomes, housing represents a higher cost than it did in previous generations, say back to about 1970. However, this consideration is purely in terms of the cost of housing compared to the level of household incomes. It doesn't take into account the household dependency ratio. That is, it's not moderated by the fact that the household now has to support a smaller number of dependents. And this is reflected when we consider the fact that over the same period, households have fallen in size, and therefore they have a smaller household dependency ratio. This is shown as the green line on this graph. When we apply this falling dependency ratio to the purchasing ability of households, what we find is the double incomes are able to go further. They are more powerful. They are able to support a higher standard of living. This is shown in this final trace on this chart, which is the dependent adjusted income. What this teal coloured line does is adjust the pale green household income by the fact that household size has been falling, especially for those age groups where in previous times there would be families forming. What we see is that the dependent adjusted household income has actually risen quite alarmingly from 1970, in fact significantly ahead of housing costs and general costs. What this means is that while we choose to have the second income, overall it's meant that as a community the average household has been better off over the last 40 years or so. However, a significant thing happened in the early 2000s, somewhere around 2002-2003. At that point, house prices, at least as indicated by the Australian House Price Index, once again moved into parity with the dependent adjusted household income. And since that time, it appears that movements in house prices have been following pretty much the dependent adjusted household income. What does this mean? Well, to return to Abelson and Chung, the intergenerational equity is an intergenerational equity in terms of the standard of living enjoyed by a household now requiring a smaller number of dependents, in other words, a smaller household size, and a larger number of incomes. But on that basis, our standard of living is more or less the same as it was in 1970. The only difference, of course, is that biologically it's going to be very difficult for an economy which now has housing risen to the point where it takes out the economic vitality, forcing households to always have double incomes and very few children, to be able to reproduce itself into the future. This is going to be a problem in coming decades. Generally, we know it as the problem of the ageing population. We can now move to some conclusions. What we've seen is that house price growth between 1970 and 1990 was largely on the back of the ability of households to have double incomes for the first time in history without children. House price growth from 92 to about 2005 was on the basis of being able to borrow to cash in on the negative gearing strategies that had been learnt through the previous 20 years. Overall, both of these factors have found their way into house prices to the point where they're now a necessity. In one way or another, we've lost sight of the fundamentals. Rents must come from tenant income. However, tenants don't seem to have any more capacity to be able to pay up the rent. And this means that rents in the long term are not going to be able to increase, regardless of whether the supply of housing is high or low. And overall, as a community, we can't afford the next generation. And this is a problem which is going to become more obvious in coming decades. Largely, these effects are focused on property, And that's largely because property tends to act as a residue. It tends to absorb the economic resources of a community, everything which is not needed to support the physical immediate side of the standard of living. The long-term challenges that come from this reality is that the difficulty we have with supporting households that have families means that in the future there will be a diminished workforce. A diminished workforce necessarily means diminished economic demand, which is going to have impacts on industrial, commercial and retailing property, but most directly on residential property itself. And so the long-term prospects for property, so long as we're not able to maintain our population trends, is not going to be very promising. And so a shoulder looks as though it may be around the corner. This would suggest that for property economists, it must be very important that we follow closely the debate on the ageing population and also on the matter of immigration, because one way or another, Australia will begin to rely on immigration in the future in a way that it never has in the past.